In today's episode of the Michael Yardney podcast, I'm going to be sharing some fundamental lessons about location and the type of properties that are going to outperform moving forward as we discuss what I learned about real estate by playing the game of Monopoly. Now, welcome to the summer series of the Michael Yardney podcast. While we normally produce 2 shows a week, over January, I'm going to be offering you 3 shows each week, a combination of new shows to keep you updated with what's happening in the world of property, money and finance. But we're also going to be replaying some of our previously published shows, which is what's happening today. But this show received lots of downloads so that if you are a new listener, you may have missed this. Now, it's a good time to go back and listen to some of the past episodes anyway. And if you're a long-time subscriber, I believe you're still going to get benefit from the shows we're going to replay because I've selected them because of the special messages I want to share with you. So you're going to find that most of the shows in this summer series aren't really about what's happening in the market right now, but today, like in the other episodes, I'm going to share some fundamentals that I believe will be critical to your future success. So welcome to today's show. Have you played Monopoly recently? Monopoly's been a classic board game for over a century. It's a real estate trading game played for fun. And it's also a chance for any of us to become a real estate tycoon. Now, I recently played it with some of my grandchildren, and it actually annoyed me that I wasn't able to borrow money to buy property, but I was still hooked on the thrill of accumulating properties and collecting rent and winning. But I also realised that there were some valuable lessons all investors can learn from the game of Monopoly that they can carry with them into property investment in real life. And I'm going to share them with you in today's show, as well as my mindset message, where I'm going to show you how you can become wealthier by becoming more grateful. Don't worry if it doesn't make sense at the moment. You'll understand once you've heard my message. Now, for the many new listeners to this podcast, well, welcome. I know there's lots of you because I see the download numbers increasing show after show. But of course, I don't know who you are. If you're enjoying the show, I'd love you to subscribe because twice a week we bring you lots of information, and usually I have a guest with me and we have some great conversations about property investment, success and money. But every now and then I do a solo show, as I'm doing today. And that happens especially when I think there's a very important message to get across. So let's see if you think my message today is as important as I think it is, and welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
I recently did something I haven't done for a long time. I played a game of Monopoly. And yes, I won, but I played with my grandkids, so I think I had an unfair advantage. But the game reminded me of some very important lessons that all property investors must understand, and that is that not all real estate is equal. You see, everyone wanted to buy Mayfair, the most expensive street on the board, and no one really wanted those cheapy locations on the other side of the board. I don't even remember what the name of those are. Then there were those other locations in the middle of the Monopoly board. Some were more desirable than others. And it's the same in real life. Not all real estate locations are equal. And just like there are different precincts on the Monopoly board, there are basically 4 types of location where you could buy properties in the real world. And as you'll see, a lot of it has to do with the demographics, the people who want to live there, who can afford to live there, and who are planning to live in those suburbs. And that's going to make a big difference with regard to the performance of your investment properties. And as you've heard me say often, location does a significant amount, maybe up to 80% of the performance of your investment property, because you can change the property, you can upgrade it, you can refurbish it, you can pull it down, build something new, but you can't change the location. So let's have a look at the 4 distinct types of location where you can buy property, and I'll explain to you the ones I think you should be considering and the ones you should avoid. First of all, there are Discretionary locations. Now, these are the most expensive locations in our capital cities, what I sometimes call the established money locations. And that's because most of the residents in those locations have lived there for a long time. Many of them have paid off their home loans years ago. That's why I'm talking about established money suburbs as opposed to the young new money suburbs, the outer suburbs, where the new first homeowners have got large mortgages against their home, and where all the homes are much the same, while in these established money, leafy, expensive, discretionary suburbs, these are in general in the established inner ring suburbs of our capital cities or suburbs close to the water. Think of Toorak, Brighton, Kew in Victoria, Tenerife or New Farm in Brisbane, Darling Point or Bellevue Hill in Sydney. Now, over the long term, this sector of the housing market outperforms other segments. Look, it's in part because of the scarcity, but in particular, as we know, the rich are getting richer. They're getting richer than the average Australian, and they can afford to. And they're prepared to pay a premium to live in these prime locations, which are scarce. Interestingly, over property cycles, these suburbs often are more volatile than you'd expect. You see, during property booms, during periods of economic growth, when the economy is doing well, wealthy Australians have got the financial capacity to indulge their emotional wants, and they buy the most expensive properties they can. And then during the inevitable economic downturns that happens in every cycle, when businesses aren't doing as well, the wealthier people don't have as much security, there's comfort, they're not getting the dividends as much, they tend to quieten down. They don't lash out and spend in these areas. But over the long term, this segment of the market outperforms other sectors. It's been shown over and over again over the long term to do that. But of course, not everyone can afford to buy at this top end of the market. So the next area I'd suggest strategic investors look at are aspirational suburbs. Now, these are in the upper middle class areas, and they're gentrifying locations in our big cities. Think of Bentley or Elwood in Melbourne, Paddington, Mosman, Randwick or Newtown in Sydney, Camp Hill or Grange in Brisbane. These are suburbs where many of the more affluent millennials are aspiring to move to. Remember, I call them aspirational suburbs for a reason. The millennials in particular are wanting to enter these suburbs because they're getting to the family formation stage of their life. They don't want to live in apartments in the CBD anymore. And when this wealthier demographic move into the suburbs, they tend to push up property values. So how do you find an aspirational or gentrifying suburb? Well, just walk through, drive through. You'll see the changing neighbourhood. You'll see new developments occurring. You'll see infrastructure improvement. You'll see people pulling down old houses and building new houses or renovating houses. You'll see the type of cars they're driving. You'll see the restaurants are changing, the cafes are changing, and the sort of things that they're selling there. So I believe aspirational and gentrifying suburbs are a great place to buy investment properties because this gentrification process takes a number of decades. And so you're not only getting the rise in value of the general property market, but the improvement in the area as more gentrification. Gentry means remember the old English term, the landed gentry, the wealthy people. They actually are replacing the older people and lower socioeconomic groups that lived in those areas before, and they're improving the areas. By the way, this is not just owner-occupiers. It's also tenants who choose to live in these aspirational suburbs. And I want the tenants in my properties who can afford to pay me higher rent as time goes on. So therefore, I have a lot of investments in aspirational suburbs. Of course, this creates a ripple effect, producing economic, social and cultural changes. Now, there are a number of different types of aspirational suburbs, but if you think about it, there are lifestyle suburbs. People want to live in certain lifestyle locations, such as Bondi or Fitzroy in Collingwood in Melbourne, where there's a particular hipster or lifestyle that suits certain people. Of course, there's the beach, water, sandbelt aspirational suburbs where more and more Australians want to be close to the water, close to the beach. There are the school zone aspirational suburbs. Lots of people want to, as they're getting into family formation age or as their families are getting older, want to be in a great school zone, a public school zone where they don't have to pay as much to get their children into the good schools, and they're prepared to pay a premium for that. Not just owner-occupiers, but tenants also. So that's the type of area that I invest a lot in. I've got quite a lot of new townhouses I've built in great school zones. Never have trouble finding tenants for those. There are also knowledge centre aspirational suburbs where people are wanting to live because it's close to the universities or close to hospitals or close to work. There's cultural aspirational suburbs where various cultures want to live with other people from their background. There's some great suburbs that have performed particularly well because the wealthier Australian Asian community want to live there. And there's also tree change, seed change, aspirational suburbs. So as we're going through this, I'm pointing out that there are different types of locations, and you've got to understand what type of location you're investing in, because some are going to do well. You've heard me talk about the concept before that the rich are getting richer, and this isn't going to change. So you need to have the type of property that's going to be in continuous strong demand by people who can afford to pay more for it over time, and tenants who are going to live in those locations and who are going to be able to pay more rent. So the next group of suburbs, I'd be much more cautious about investing here, but this is where most investors invest, and why most investors don't do well, are what I call affordable locations. This is, as I said, where most homeowners and many investors look, because that's where they can afford to buy, or they've been told you should buy around medium price or the lower price bracket because more people want to live there. Well, they don't particularly want to live there. They don't wake up in the morning and say, I want to live there. They wake up in the morning and say they want to live in aspirational suburbs, but they live there because that's where they can afford to. I know many investors have been hoodwinked a bit by so-called advisors who tell them to buy at the cheaper end of the market. Now, there's no doubt some affordable areas will make good investment locations, especially those that are going to benefit from the ripple effect of being next to it, joining aspirational suburbs, because eventually they're going to become the aspirational suburbs themselves. As the ripple effect moves on, as affordability in the more expensive areas becomes difficult and people just go further out. The trouble is there's so many affordable suburbs, so a lot of Australians who are looking for a home just keep driving until they can find somewhere they can afford. Similar with tenants, and that's not the sort of area that's going to outperform in the long term. So if you want to become a successful property investor, you have to do things differently to what most investors do, and you should be looking for areas that are going to outperform the averages and give you wealth producing rates of return, because most locations at the affordable end of the property market will underperform with regard to capital growth and rental growth, because many of the owners in those areas are young families. And again, please, this is not a judge of people, but it's a fact that many of these young families have stretched themselves to their financial limits, and they're often only a week or two away from being broke. And similarly, the tenants who rent in these locations live there because that's all they can afford, and they're unlikely to pay or be able to pay you increased rent over time, since they're also only a week or two away from being broke. So as an investor, I'd steer clear of most affordable suburbs, because most will never gentrify in your lifetime. They're not the areas where wealthier people are going to come in and improve them over time. So they're going to underperform with regard to rental growth, the thing that you want to live off, and of course capital growth, where you want more equity so you can buy more properties. Often owning properties in these locations will be more trouble than they're worth. And then there's a fourth type of location. In every city, there are suburbs that, let's call them last choice locations, suburbs where people live because they've really got no other choice. No one wakes up in the morning wanting to leave in these suburbs, but social circumstances force people to. Of course, as an investor, you really should steer clear of these locations. So just like owning the right locations on the Monopoly board, owning an investment property in the right location will do 80% of the heavy lifting for you. But there's more, as they say in the ads. It's not like all properties in the same location are going to do well. Not all properties in each location are the same, are they? Even in the best suburbs, there are still some properties I'd avoid. They just don't make good investments. And others I'd be really keen to have in my portfolio. So in every location, there are A-grade homes. You've got to get the right type of property for the right location, but A-grade homes and investment-grade properties are the type of assets I believe you should want to own the type of properties where great tenants are going to want to live. Again, as I keep saying, not because they need to live there, but because they want to live there and they're prepared to pay extra to live there. Think of family-friendly apartments in great neighbourhoods like Bondi in Sydney or Elwood or Fitzroy in Melbourne. A-grade homes in good locations, investment-grade properties, they'll outperform with regard to capital growth. As I said, there are different types of property in every location. The next one are B-grade properties. They've still got a lot going for them, and during the hot markets like we've experienced much of this year, they're going to perform really well. But their secondary location within the suburb or the less than perfect attributes these properties have got means that when the market slumps, as it does, we're going to have downturns again, buyers and tenants are going to be more choosy. Usually, when the markets pick up, there's a flight to quality. People only want to buy better class properties until the FOMO kicks in right at the end of the cycle. This time round, it was actually very different. FOMO kicked in very early in 2021, end of 2020, as our markets picked up after a couple of difficult years. And so the flight to quality disappeared. People are trying to buy anything and everything because there was such a shortage of property. But my suggestion is, you, as a long-term investor, you should be sticking to A-grade homes and investment-grade properties, or a B-grade property that you can improve, and avoid C-grade properties. So there should be avoided unless they're in a great neighbourhood and your intention is to demolish the property and replace it with something more appropriate for that location. So interestingly, the last property that Pam and I bought, in fact, the two that we've bought this year, have both been C-grade properties, but in great locations. And in both cases, they're going to be pulled down. Interestingly, one of them we weren't even able to get inside and inspect because the current sitting tenant there gave the selling agent and the owner a really, really hard time. And it wasn't because of COVID, even though that was part of the excuse they used. They just made it impossible for people to inspect. But because I was really wanting to buy the land, the location, pull that property down to build two townhouses, made no difference to me. In fact, the second one we just bought recently in Brisbane, similarly, was a derelict property with a hoarder living there, a relative of the owners, wasn't able to be inspected. They couldn't do the auction on site because it was in terrible location. But I could see past that. So I was happy to buy a C-grade property because of the location. But that's because the intention was always to demolish it and replace it with something more appropriate for the location. So the bottom line is, just like in Monopoly, not all real estate is created equal. I know it's often said that a rising tide will lift all ships. But in real estate, that's not really true. A-grade homes and investment-grade properties in discretionary suburbs, in aspirational locations as well, the first two of the groups I talked about, they're currently outperforming other types of properties, and they're likely to continue to do so as affordability bites and affects the lower end of the market, which is going to have more difficulty seeing prices rise. So be careful. Don't be stuck with an underperforming property in the wrong segment of the housing market when this cycle ends, because when it will, and it will, if history repeats itself, and it most likely will, you could end up owning a dud property that you're going to regret owning, and you're going to have difficulty selling if you need to, and you'll have difficulty getting the type of tenants that are going to be able to pay you more rent. So I was reminded of some lessons from Monopoly when I played with my grandkids. It sort of rang true, but this is what I've been talking about all along in these chats I'm having with you. So I hope you've got some lessons from my learnings as well. In a moment, I'm going to share my mindset message with you, where I'm actually going to ask you to do a particularly interesting mental exercise that I believe is going to make you feel wealthier, more grateful. But before we get into that, just following on my chat about Monopoly, now that we're into a new year, more property investors are going to return to the market this year. This always happens at this stage of the cycle. And as we finished off 2021, property investors were returning to the market as first home owners were leaving the market, and even finance to existing homeowners started to drop a bit. So far, this cycle's been driven by owner-occupiers, but now as more and more investors are getting into the market, I guess they're hearing about strong house price growth, what tends to happen is a whole generation of new investors comes in late in the cycle when they hear about how well others have done. However, if history repeats itself, and it most likely will, many of these investors won't do well and they'll sell up over the next couple of years as they realise the property investments they made don't work. They're going to realise that property investment may be simple, but it's not easy. Now, you've heard me say that before, but moving forward, a rising tide won't lift all ships. You've heard me talk about us having a two-tier market moving forward. And so if you want to understand what's happening on the ground, if you want to actually even the odds, actually put them in your favour, why not have a chat with my team at Metropole? Because what we would start doing, even before we talk about where to buy, what sort of property, what sort of location, we talk about you, what your needs are, what your plans are, what you want to achieve, and we'd help you build a strategic property plan that will give you a realistic expectation of what you can achieve. We'll talk about how you're going along your journey and what you need to do to get there if you're not heading in the right direction. Only then we start talking about exactly where and exactly what sort of property. By the way, we don't sell any property, and that means our advice can be independent. We give holistic advice because we've got a financial planning division, wealth advisory, property management, renovations, development, business advisory, and of course strategic property advice and bias agency. Go to metropole.com.au, find out about what we do, and why not allow me and my team to be part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'm going to ask you, well, in a moment anyway, to imagine it's all gone. But first, let me explain that I like to think I'm an optimistic person. I am. I tend to believe things are going to work out. Of course, impartial scientific analysis of the world for, I guess, over the last 5,000 years tends to support this thesis. It works out. I also believe that to be a good investor, you've got to be optimistic. You have to have an unwavering faith in the future. However, I recently came across a technique that is, in some ways, the opposite of thinking things are going to work out. It comes from the Stoics, and apparently it's been around 2,000 years. So I figured it's worth paying attention to anything that's been around for more than 2,000 years. And this technique I want to just talk to you about in this session is the technique of negative visualization. Now, negative visualization is about imagining that you've lost all the things that you value. Your home, your job, your sight, your ability to work, your husband or your wife, or even your children. They're all gone. Now, it's easy to have an immediate aversion to thinking this way. What do you want about, Michael? Aren't we supposed to think positively and therefore manifest all the things we want to in life? Well, bear with me. Some of you may be thinking, well, doesn't negative thinking tempt fate? Well, apparently the Stoics believe absolutely not. They say premeditation malorum, which translates as something like premeditation of evils, has a huge benefit. Now, the Stoics use it to ward off hedonic adaptation. That's our tendency as humans to quickly get used to the things, good things and bad things, in our life. I don't know, let's give an example. Buying a new car, you get temporary happiness, you get a boost, you get excitement, but after a short period of time, many of us sort of return to a baseline level of happiness, don't we? Now, unfortunately, this can lead to a constant dissatisfaction and an ability to step off the treadmill. You keep looking for more things, don't you? On the other hand, imagining everything you've got has been taken away from you, well, that induces feelings of gratefulness. Now, William Irvine writes in a book, his book was called A Guide to the Good Life. Most of us spend our idle moments thinking about things we want to, but don't have. We'd be much better off to spend this time thinking of all the things we have and reflecting on how much we'd miss them if they weren't ours. Interesting way of thinking, isn't it? Another benefit of negative visualization is that by anticipating disaster striking, we're more prepared for it when it does. I guess we're psychologically toughening ourselves up, aren't we? Now, fingers crossed, disaster's not going to happen. And we don't need it to happen in order to have the benefits. Many people who go through a catastrophe report feeling joyous, feeling thankful, feeling grateful to be alive after having the experience. I'm sure you've heard those stories yourself. But we can't wait. We shouldn't wait for disaster to strike in order to feel that way. As William Irvine explained in his book, negative visualization can be done repeatedly and the benefits, well, they can last indefinitely. He said negative visualization is a wonderful way to regain our appreciation of life and with it, our capacity for joy. Now, I'm not saying stop being optimistic, of course not. And I'm sure the optimists do better than pessimists in all areas of their life, including in relationships, including in business and investing. But I do think trying this as an interesting experiment is worth a go. I really felt the benefits when I tried this exercise, the exercise of, for a moment, imagining losing everything. After thinking about Pam not being by my side, I had to go across to her and tell her how much I love her and how much I cherish her being in my life. And when I next saw my grandkids the next day, I hugged them a little harder and a little longer. Now, I know you might be thinking, what a way to live walking around with all those pessimistic thoughts. That's not what I'm suggesting. In fact, I'm suggesting that at least once a day, you should think of 2 or 3 things you're grateful for. Every morning when I get up, I look for 2 or 3 things I'm grateful for, and I can't use the ones I used the day before or the day before that, because I believe unless you are grateful, you'll never truly be wealthy. Now, we normally characterize an optimist as somebody who sees the glass half full rather than the glass half empty. But as I was reading about this concept, I learned that the Stoics, though, to them, this degree of optimism is only really the starting point. After expressing his appreciation for the glass being full, or half full rather than empty, he actually then go on to express his delight in even having a glass. I mean, it could, after all, have been broken or stolen. So I'm not suggesting go around all day contemplating potential catastrophes. Of course not. But I do suggest that periodically, every now and then, you should actually maybe pause in the enjoyment of your life to think about how all these things could be taken away. It's brief, it's practical. Furthermore, there's a difference between contemplating something bad happening and worrying about it. Now, contemplation, I guess that's an intellectual exercise. It prevents us from taking the world for granted. This is a powerful philosophy that can carry through into your financial life as well. Now, I've often talked about Morgan Housel, one of my favourite authors, who used to write for the Motley Fool and now for the Collaborative Fund. And he explained in his book, and it's a great book that I suggest you get, The Psychology of Money. I've got it on my Kindle and I love reading it. Morgan Housel said that to be financially successful, you need a barbelled personality. You need to be an optimist about the future, but paranoid about what will prevent you from getting to the future. He said you need to save like a pessimist and invest like an optimist. So financial planning, and at Metropole we have actually 2 separate financial planning licenses with Ken Race, our wealth advisory division, does financial planning, but also Spark Private Wealth, that company that does financial planning, is part of the Metropole group as well. And I learned to some degree it really is simply a process of negative visualization. To answer the question of how much life insurance you need, you really have to work through the scenario of you're not waking up one day. And at the same time, you need to acknowledge that it's a possibility. To get an estate plan in place, as Ken Race does all the time, we really need to talk about how you want to look after your loved ones, but when you're gone. Again, acknowledging that one day you're not going to be there. To think about liability insurance, you need to talk about how disaster could strike. To earn the luxury to invest in what can go right, you first have to protect against what could go wrong. So by going through the process of negative visualization in our financial life, we can prepare, we can plan, and we can balance optimism with realism. So as Morgan Housel said in his book, you can be optimistic that the long-term growth trajectory is up and to the right, but equally sure that the road between now and then is filled with landmines and always will be. And those 2 things are not mutually exclusive. So, in summary, be optimistic, be grateful. But why not just try that exercise? Imagine it's all gone, and then all of a sudden, I believe, like I was, you're also going to be more grateful. And when you're more grateful, you're going to be much, much wealthier. Thanks for spending the last half an hour or so with me as we talked about wealth and you achieving the sort of results you want by understanding the rules of Monopoly and also by having some different expectations of your life, as I discussed in my mindset moment. And if you got some benefit from this, if it's actually made you think a bit differently about property and about your wealth journey, and you know somebody else who'd benefit from this type of information, please do me a favour. Help me in my quest to make as many people as financially fluent as possible and tell somebody about the Michael Yardney podcast. Just one person. That'd be a great favour to me. Of course, you could tell the world by leaving a review on whatever podcast app you're listening to this as well. Now, I'll be back again real soon, but you can catch me in between these shows on social media. Just look for Michael Yardney and join my private Facebook group. Go to Facebook and look for the Property Update Facebook group, where every day I leave some tips, some hints, some graphs, some charts, something a little bit different. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?